Hello everyone, my name is Bukky and I'd like to say welcome to my channel once again, your number one place to learn about personal finance and career. Well, for you that you're just coming around, I hope you're able to learn one or two things and then you're able to stick around in this channel. And for you that you're coming back, I'd say thank you. Without you, I cannot be here. Well, today I'll be talking about 5 ways to start investing as a beginner in 2020. Many of us, or so many of you guys, are already thinking about how you want to go about your personal finance in the new year. You're already thinking about, okay, you need to do better. You need to do better. You need to start. If you've not been working towards saving towards your retirement, you need to start thinking about it. If you've not been thinking so much about investing, you need to start thinking about it. And the good thing is, this is the time where you sit down and mull over this topic and then come up with a strategy on how you want to start investing in 2020. So this is the right time for you. I hope as you listen to me today, you're able to take a few things away with you and you're able to work on it. And I hope that by the end of 2020, you will be so glad that you had an opportunity to listen to this video in 2019. So sit back and watch. By the way, have you ever thought about becoming a millionaire someday? Well, the good news is it's possible. However, one of the ways that you can go about becoming a millionaire is to invest. Start investing. That is one of the basic ways that you can become financially free life. So if you've not started investing, if you've not really done so much about your investment, I think this is a good place for you to start. Just sit back and listen to all I would be sharing with you today. I have really tried to break down the things I'm going to be talking about today into very simple ways, or I'm going to be using very simple languages that people who are not so much exposed to this topic would also have insight and would have at least the basis to go about their investment. So don't worry, I will not try to use any jargon. I'm going to be using very basic things, and then I hope you're able to take them with you and run with it. And the second thing is, before I take a deep dive into these 5 ways of investing as a beginner in 2020, I would like to define for you what exactly do we mean by investing. When you think about investing, what comes to your mind? Well, investing is an art of putting aside some amount of money, put it into ventures that can create profit for you without you lifting a finger or doing any heavy lifting. However, before you start investing, you have to think about saving. I said, when I was defining investment, I said investing is an art of putting money aside into ventures whereby you expect these ventures to give you returns, right? But then the first thing you have to do is actually to put the money aside. So if you cannot save, it will be really difficult for you to invest, because it is the money that you've saved that you are supposed to invest. So if you've not seen my video on how to save, go here and listen to this video, and then you can already start taking the first step, even this year, towards saving and then investing your money. I would like to also quickly talk about 2 myths that discourages people from investing. The first thing is, oh, I am too old, I'm in my 30s, I'm in my 40s, I cannot start now because then I've lost so much time. The truth is, you are not too late. You can start where you are now. I know, because there's this famous effect in investing, which is called the compound effect, and that is the earlier you start. So if you are a teenager and you're starting now, your capital and your interest continue to generate income, and then those income they're generating, you keep redeploying them back into the capital, and then that also generates more and more. And before you know it, maybe you started with 10,000 naira at a time, and maybe within 10 years, if you're consistent and you're redeploying back the income you're getting on the initial 10,000, you might end up getting so much as, if you have a good return, say like 10% returns, you can end up after 10 years with maybe 20,000 or even more. So the compounding effect of investment is something that is really important, and it's as simple as saying that the earlier you start, the better. So don't say that you are in your 30s or 40s and it is too late. start now. And if you're in your 20s or you're still a teenager, if you have the opportunity, start now, because the earlier you start, the better for you. The second myth is that it's only the rich people that can invest. That is not true. Whether you're rich or not, you can invest. You have access to putting your income or your money into investment. And why do I say that? People that are wealthy today, the big investors, right? They started somewhere. They didn't have so much at a point, but they were disciplined to put their money into instruments that they believe can increase or that can bring some form of income for them. And as a matter of time, those investments actually brought income for them. And now we call them wealthy. We aspire to them. So therefore, I'm telling you, even if you think you're an average person and you feel you don't have so much, even out of your little, you can separate some amount and start investing today. And like I said before, the earlier you start, the better. So don't think it's only the rich people. Even you or myself, both of us or all of us can start investing. And then we can make some income or some profit or some returns out of this investment if we do it properly and we follow the right guidelines, which is very important. The number one way I would suggest is to buy stocks or shares of a company. When you buy stocks of a company, you are being part of the ownership of that particular company. And you can think, okay, so how do I make profit by buying stocks or shares? Well, there are two ways you can make profit from buying the stocks of a company. Number one way is that you can gain dividend, which sometimes is just once in a year or twice in a year for companies that declare interim dividend. So you invest $1,000 into a company, and the shares of that company one share is worth $10, right? So after you invested your $1,000, you're able to get 100 shares. At the end of the year, if the company pays $1 per share, right, you are entitled to
$100 for 100 shares
before taxes, right? So when you get
$100 for 100 shares,
remember that you just put the money there after 1 year. Yeah, you just put the money there and you're not doing anything you don't need to analyze, you don't need to do any work. The money just works for you. That $1,000 just works for you, and at the end of the year it's giving you a cash flow of $100. That is a way of investing. So imagine that you invested, instead of $1,000, you invested like $100,000, or even let's say $10,000. You get free $1,000 at the end of the year for doing nothing, because of the fact that you invested some amount of money. So that's one way to get income through shares. Another way you can get income from shares investment is capital gain. What do I mean by capital gain? So imagine this year, or imagine in 2010, you invested this $1,000 into a company, and as at that time, their share price was just $10, right? And now in 2019, the company has done well. They've increased their share price, and their share price is trading for, let's say, $20 per share. Within the space of 10 years, that $10 share that you bought has been able to increase to $20. So if you want to sell your share after 10 years, instead of getting $1,000 that you invested initially, you're going to be getting $2,000. But because you are a long-term investor, you say, oh, I can still leave it. But the point I'm trying to tell you is that your $1,000 can become $2,000 after 10 years if the share price increases. So that's what I want you to know about stock investing in stock. However, I would also really implore you that you don't just go about buying stocks. Please contact a stockbroker, a reputable stockbroker who can advise you and can also connect you to the secondary market. One thing you have to look out for in stockbrokers is that you are going to look out for someone who just want to collect a one-time fee, and not someone who would be getting an income or a percentage of your returns, because at the end of the day, that will not really pay you. So you just want someone that you can pay the consultation fee once and for all, and that's it, and the person doesn't have access to get a percentage of your returns. In another way, some banks do actually help people to buy stocks, especially those banks that have asset management department or business area. And I also know that sometimes they do it for people of high net worth. But you could ask your account officer in your bank and say, you know what, I'm interested in buying some shares. I want to create a portfolio for my investment, for my retirement. Can you help me, or what would you suggest? So some of them actually do have that service and they offer it. But most times they do it for people with high net worth. But just go ahead, it doesn't hurt to ask. And one other thing that I would say it's really important is that when you're buying stocks of shares, or when you're buying shares or stocks of a company, make sure you read about the company. Make sure you read their prospectus, look at their business environment, how they intend to improve or how they intend to increase in the coming years, because that would give you more information to know if the stock of that company is worth buying or not. And by the way, in business or in investment, it's not about winning all the time. Sometimes you lose. So you have to be careful, and you also have to have in mind that it's a risk. Investment is a risk. It's likely that you lose your money, but also it is likely that you gain something out of it. So you have to beware and be informed. Stay informed. Information is key when you are thinking about buying stocks or shares of a company. Another thing I would like to tell you about buying stocks and shares is that I can tell you it's a complex business, right? And that's why I said you should talk to a stockbroker who can help you to get a hang of it, or to talk to your account officer in your bank, But if you think you want to go it alone, I would also say that you should look out for companies that are established, companies with big capitalization in them. It means that a lot of people already trust them. I know I shouldn't be telling you to follow the crowd, but for now, as a beginner, just do a little bit of following the crowd in a way by investing in those big companies that already are solid, that have strong market capitalization. That way, you kind of have some more security than investing in companies that you're not sure of. You don't know what their business models are, and they've not really been tested. Another important thing for you as a beginner in share or stock investment is to have a long-term value view rather than a short-term value view. What do I mean by long-term value view? When you buy stocks and shares as a beginner, don't go and say, okay, after a few months or after 1 year, you want to sell it off, right? Because you're not an expert in these things, right? So buy it and hold. Yes, just buy the stocks and hold it. Sometimes the prices will drop, but sometimes the prices would increase from experience. So have a long-term view, and that's why I said you should talk to people that are experienced, talk to stockbrokers, or talk to your account officer, and they would recommend you to one of the asset managers that can guide you on what to buy. But the second way you can invest as a beginner in 2020 is by investing in mutual funds. What are mutual funds? Mutual funds is a pool of funds or a pool of money from different investors, and this money is invested in particular stocks in the market. So a mutual fund does not invest in the whole of, a particular mutual fund does not invest in the whole of the market that it is operating in. Rather, it picks specific stocks depending on what the goal of the fund managers are. So it picks on specific stocks, and these stocks forms a portfolio of that mutual fund. As a beginner, you also want to know that a good thing is that you diversify your investment. Don't just invest in just one thing. Invest in several other things. And investing in a mutual fund is an automatic way of you diversifying your investment, because it will have been more work for you if you are the one going about picking all those stocks on the market and processing them as a single stock. But with a mutual fund, which you buy from fund managers, they already have a portfolio of stocks in a particular fund, and then you're just buying a piece of that particular portfolio. Well, why am I recommending mutual fund? Because like I said, it's a way of you diversifying your fund and your investment, and you don't have to do so much work of market analysis or following the market, looking at price of the individual stocks. Rather, the fund managers are doing that. They will be the one to take care of that. Of course, they will collect some fee, maybe a loading fee to invest in their fund, but they are doing the heavy work. They are doing the heavy lifting for you. So that is why going for mutual funds as a beginner, it's very recommended, right? It's something you should take a look into. One other important thing is that there are different kind of mutual funds in the market, in whatever market you are. You're in Nigeria, you're in the US, you're in Germany, you're in UK, wherever you are, there are mutual funds that are operated in those countries that you are. The thing about mutual fund is that the nature of the security that mutual fund is invested in determines how it is sometimes named or what kind of value you are expected to get from it. For example, there are some mutual funds that are categorized as value mutual funds. Those kind of funds are expected to have like 100% investment in equities, in stocks, in the stock market for the respective market that you are, or for the respective country that you are. We also have, for example, money market mutual fund. For a money market mutual fund, you can expect that a huge percentage of that portfolio is invested in money markets, right? Like T-bills or bonds or things in this category. So, and then you have a lower percentage invested in equities, and that's a money market fund. You can also have, for example, a balanced fund. What is a balanced fund? A balanced fund can be that it's a 50-50 percentage in terms of stocks and bonds, right? So, like I said, depending on what kind of funds, what kind of things are included in funds, that way you can categorize it. So ask questions. When you hear a particular name of fund, just ask and read the prospectus. What exactly is in this fund? And most times the fund managers are quite open their expertise and say, okay, as this particular mutual fund has 10% of A, 10% of B, 20% of C, 70% of D, and blah, 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 blah. So that is how they communicate it. Therefore, because there are different categories of mutual funds, right? You would expect each or different mutual fund to give you different values. So for example, a value mutual fund would have a higher risk, but it will give you more returns, and it can also give you less returns. That's the truth. However, a balanced mutual fund has a lower risk because of the 50% investment in bonds, which are a more secured kind of investment. However, the returns that you get from it compared to the value mutual fund will be also kind of lower, right? So you also need to look at your risk appetite. How open are you to risk? You know, this is something. Risk is something. It's also a very broad topic. That needs discussing as an investor and as a beginner in this world of investment. I can remember the first two mutual funds I came in contact with. One was called Aggressive Fund, and the other one was called Discovery Fund. And after reading their prospectus, I realized that the Aggressive Fund invests as a portfolio with 100% focus on the Nigerian stock market, like 100% equities, right? And then the Discovery Fund has, I think, maybe 70% equities and 30% bond. But then I realized that the returns, so the Aggressive Fund has a higher returns, but higher risk. And the Discovery Fund has a lower return compared to the Aggressive Fund, but a lower risk, right? So, and that's, for example, a very practical example I can give you. That depending on what is in that particular portfolio, your risk and your returns, your risk and your returns is determined by what your portfolio of the mutual fund you're buying is made up of. So be informed, ask questions from your asset managers, read prospectus. You know, don't forget to read and get informed, because that is when you know what exactly you are investing into, and then you can decide and make an informed decision of what you are expected to have in form of return. Some popular mutual funds that you can look out for include the Fidelity Contra Fund in the US. In the UK, you have the LK Lintel Train Equity Fund. In Nigeria, you have the ARM Discovery and Aggressive Fund. So those are some of the funds that you can look out for. But like I said, make sure you read the prospectus, ask questions if you're not clear before you make any form of investment. But I can tell you mutual funds are quite diversified and the risk is lower, and you have people who can manage these things for you. So that's why I'm recommending mutual fund as a beginner. It's a basic thing that you would have instead of you going actively into the stock market by yourself to buy single shares. My number 3 way that you can invest in 2020 as a beginner is to invest in exchange traded funds. They are called ETFs. What do I mean by ETFs? Well, some fund managers, they've come up with the fact that, okay, you know what, we want to really reduce how much we lose, in terms of money, because they believe that the market adjusts itself, So what they do is they create some kind of funds, they put some kind of portfolios together, and they benchmark it to the market, so to the market index. I don't want to get into complicated things right now because ETFs are quite complicated, but they are also simple. So what the fund managers do is they create these funds and they use it to track the markets that those funds are traded in. For example, one of the most popular markets is the S&P 500, or that's for the US. For the UK is the FTSE 100. For Germany is the DAX 30. For Nigeria is the normal NSE. So fund managers create these funds, right? And they use it to track the market, and they try to beat the market. Yes, that's what they try to do. They try to beat the market. And then, so you are buying, if you buy an ETF, you can buy it over the counter from your stockbrokers or from your fund managers. If you buy an ETF, it's like you are buying into the whole chunk. You are buying different stocks, maybe even all of the stocks in that particular market, because they believe that if a particular stock in that particular market drops, at least the other ones will adjust. So your ETF fund will perform as well as how the market performs, and sometimes your fund can even perform better than the market, but it's kind of shores of losses, because instead of you, like I said, instead of you investing your total investment in one particular stock, right, in one particular share, you are investing in the whole market, right? So if there is a loss somewhere, at least the other ones will show up your losses, and if there is an increase somewhere, at least it will that particular increase will bring up your losses. And that's why ETF is also recommended. It's a complex business. I don't want to go into details. I will take some other time out to explain to you as much as possible ETFs. But then the thing is, you can look for on the internet. There are different platforms where you can buy ETFs, and the thing about ETFs is that you can trade them all day long, right? Compared to mutual fund where you can only buy it once in a day after the market has closed. But ETFs, you can buy it real time. Another good thing that you should know, why I would recommend you ETFs for you as a beginner, is because all the heavy lifting of analyzing the market, of looking at which market is doing, which stock is doing well, which is not doing well, it is done for you already if you purchase an ETF fund. And most times these ETF funds, they have low entry points, so you can come in at a lower level. They have low management costs. It's also a way of diversifying your portfolio, because then, like I said, you are investing in the whole market, right? And in case of losses or profits, you are kind of shored up. You can check the SPDR S&P 500, which ETF fund, which is benchmarked or indexed against the S&P 500 if you're in the US. So check this ETF fund. The name is also on my screen now. Just check it up and ask your fund manager or portfolio manager, read up about it. Or you can check if you're in Germany, you can check the IMSCI Germany ETF fund. I think it's benchmarked against DAX 30. You can check the X-Trackers FTSE All Share. I think it's benchmarked against the whole FTSE registered shares in the UK. So these are just 3 examples that I think I should share with you to give you some real concrete examples, and you can also do your homework. Of course, in coming month I would be discussing more about these things, but then as a beginner I just want you to have a place to start from, so that you know that you're making progress. I want you to progress. I want you to move forward with this stuff, because I can tell you it's a very important topic and you need to start now, because the earlier you start, the better for you. My fourth way for you to invest in 2020 as a beginner would be investing in Treasury bills and in bonds. These are secured kind of investments, and they are secured and fixed kind of investment. And why are they fixed and why are they secured? They are fixed because of the interest rate. That is, the interest rate you will get from your investment is fixed. So it could be 10%, it could be 3%, it could be 12%, depending on what the person borrowing the money from you is saying. And it is secured because any which way you are getting your money back. And that is why they are called government bonds, because most times it is issued by the government. The important thing is that Treasury bills are short-term and bonds are long-term. Short-term in terms of they could be 3 months, 6 months, 9 months, or 12 months, and then bonds start from 2 years and above. The thing is that your interest rate on Treasury bills and bonds are calculated on annuity basis. So, for example, you bought a Treasury bills of say 6 months with 10% or let me say 12% returns per annum in Nigeria. Don't expect that you will get the returns of 12% of that amount in 6 months. No, because because that 12% is calculated based on annuity, right? You only get what is accrued to you out of that 12% within the range of that 6 months. So you don't, at the end of the day, you don't get the whole of that 12%. But for example, if you do that Treasury bill for the whole of the 12 months, you should get the whole of that 12% returns on that Treasury bill, because then it's a whole year. It's calculated based on an annuity, and then you get the whole of that 12% at the end of that 12 months, because it is per annum. The other one, which is bonds, like I said, it's a long-term form of secured investment. Whatever you do, you get your money back and you get your returns back. If you buy a bond for 2 years, it comes with a return of 10%, right? So they also analyze it. And if you're looking for how or where to buy this instrument, which, like I said, it's a very good form of investment because it's safe and you already know what you're getting. It is secured. Contact your bank officer. They know about it. They know what they should do, and they can guide you and tell you, okay, which one is available now, which one you can buy now. For you to decide which of the two you are going for, it depends on what exactly you need your money for. So, for example, if you're investing 1 million and you know that, okay, in 6 months you're going to need this money, I would advise you that you put this money into a Treasury bill, right? And then you know that at the end of 6 months you get you analyze returns on it for 6 months, and then you get your money back and you can use it for whatever you want to use it for. If, for example, you know that, okay, you don't need the money in the next 2 years, then I would suggest that you go for a bond instead, because then you can get, that the money is safe, it's kept somewhere, you're going to get returns on it, it's working for you, and then you are sure that, okay, at the end of the 2 years, when you need your money, you can get it back and use it for whatever you want to use it for. Well, the fifth thing I'll be talking about to you, or I'll be suggesting to you that you definitely should look at as a beginner in 2020 when you're investing, is real estate. Most times with real estate, you cannot go wrong. Of course, you can also go wrong, and that's why we have the issues of the 2008 financial crisis. However, it has shown again time over time, like when they say people with old money, they made their money from real estate. So real estate is always a good form of investment. And one of the easiest ways you can go about is by getting a mortgage. Now, I'm not a big fan of getting a mortgage, but sometimes for you to start, you just have to go for a mortgage. The catch here though is that when you go for a mortgage, always try to pay up in time. Don't look for something that would last forever until you retire and then you're paying a house for the whole of your working years, So go for a mortgage, but try to pay up as soon as possible. Always make an extra payment, maybe every month or every year or every half a year. When some huge money comes in, just use it to pay up part of your investment. It's also important that before any bank would even give you a mortgage, right? Most times they ask you, what is your down payment? They want to know if you yourself have had some savings apart that you want to use to pay as part of equity for that particular mortgage. Nobody wants to carry all your burdens for you. They want to see that you're also committed, into having that house you wanted to have. And the thing is, you don't have to go for a dream house at the beginning. You can just go for something very simple, small, but that you can easily pay up on time, right? And then when you are comfortable, you've paid it up, you can then now start thinking, okay, you want to do something else, you want to build something bigger, and then you can start investing into that. But start from where you are now. And if you think, okay, you cannot afford the whole of the money at once, you can think of buying just landed properties. Just buy a land, start from there, buy a land, and then look at how you are going to save even more to put structures on the land. I was in a program one day, and a lady was sharing how she started. This lady bought the 2 plots of land. Of course, she had some money. She made some initial payment, but then she had to finance the remaining payment with loans. After she finished paying the loans for getting the 2 plots of land, she then, as at that time, the land had appreciated. I think like it had doubled or something. So what she did was she sold off 1 plot, building her own house. She took the money for selling that 1 plot and built 2 structures, 2 detached duplex on the remaining 1 plot. After doing that, of course, she moved into one of the duplexes and then rented out the other one of the duplex, right? And that way she has been able to become a landlord of herself, and then she has an extra income from the other duplex she's renting out, or the other flat that she's renting out. So I think she actually made the right decisions at the right time. She made the right investment decisions at the right time. I would suggest that think about real estate investment. If you cannot afford buying a whole building now, look into buying just a plot of land or 2 plots of land, and maybe you can use the strategy I just told you about today. And there's still more things I would like to discuss, but I think I would like to stop here because I think it's a whole lot of information I just pushed out there. I'm still going to be talking about these 5 things as a single topic in my coming video. So I want you to take this information, digest it, regurgitate it, and digest it again, and start thinking of how you can invest in 2020. The walk or the journey of a mile starts from a step. So you just need to sit down and start from a step. Start from that step today, And like I said, if you have comments, if you have questions, if you have things bothering you that I can even explain to you further in this video, please drop them in the comments. And also I ask that you please like my video, like this video. It's a form of encouragement. It's a form of saying, what I'm putting out there is of real value to you. And I would also say that you should subscribe to my channel. Just click that subscription button, and whenever I post new things, you can get it and learn from it. And then you can also share. Don't be an island of knowledge. Be willing, be free to share it. Give it to people that don't know about all of these things. Let them learn also, because it doesn't make sense for only you to be a millionaire surrounded by poor people. So thank you. I hope today I've been able to add value to you. I've been able to inspire you or take off your curiosity about investing in 2020. And I hope to see you again in my next video. Until then, just keep hope alive.